In this video, I'll be going over 3 good index funds or great index funds to basically hold forever. Because index funds are actually considered one of the best ways to invest, especially for long-term investors who are more interested in, let's say, passive growth instead of day trading or active management. Because frankly speaking, index funds are a simple and easy way, they're also low cost, to basically invest in a large number of different stocks and companies. And the best thing about it is you don't need to actively manage your portfolio. So in this video, I'll go over a bit more about what an index fund is, why it's a good choice for most investors, and a few specific funds that are pretty popular. So first of all, what is an index fund? Well, an index fund is a type of investment where it replicates the performance of a particular index, such as the S&P 500 or the Nasdaq. So for example, let's say the S&P 500, it tracks 500 US companies with the largest market cap. Meaning if you invest in an index fund that follows the S&P 500, you basically own a little bit of each of those 500 companies in that index. So basically, investing in an index fund already helps you diversify. And diversification is important. Well, we've probably all heard the age-old adage of don't keep all your eggs in one basket. Though some people might prefer the keep all your eggs in one basket and watch that basket tightly, index funds is the other way where you don't want to keep all your eggs in one basket. But other than that, diversification is important because it overall reduces volatility than, let's say, if you had invested in an individual company. Because bringing back to the example of not keeping all your eggs in one basket, for example, if you have 10 eggs in one basket and you drop that basket, let's say all 10 break, you have nothing left. If you have 1 egg in 10 baskets, if you drop one basket or even 2 baskets, you'll still have 9 or 8 eggs left. That's the idea of diversification. Now, the other thing that I mentioned about index funds is that they usually have low expense ratios, meaning if you are investing in an actively managed fund, they usually will charge you more to keep your money invested in that fund versus an index fund. And that's because an index fund, it's passively managed. It's made to just kind of mirror whatever index is following, rather than having a person specifically picking out stocks that they think, or picking out companies that they think might be a good addition to their index, or maybe a stock or company that they want to remove from their index. So since with someone actively managing it, you will have to pay that person to do that type of work. So really, investing in an index fund is a pretty cheap way to invest in a comparable fund. And like I mentioned, investing in an index fund is passive investment, meaning it's not very exciting and you don't trade or you don't buy and sell every single day. In fact, the whole goal of it is to pick some that you want and then just hold it forever. At least until it's time for your retirement, which then you can start taking out some cash. But with index funds, you really do want to hold on to them as long as you can, because one of the things to get lower taxes is to hold it for at least over 1 year. But also, due to typical human psychology, a lot of people have an issue where they tend to buy high and sell low, and it's kind of an irrational way of trading because you end up losing money. So the best way to avoid that is really just to invest and just keep it in there. And in this video, I'm going to bring up 3 good index funds. And I know some people suggest maybe 5 or 10 index funds to own, but a lot of these funds are actually very, very similar, or they're close copies of one another. So that's why I'm only pointing out 3 of them, because in some cases, even if you invest in 5 or 10 of them, it's almost like investing in 1 or 2 or 3 of them. So the first one is the Vanguard S&P 500 index fund. And this one is pretty straightforward. It tracks the performance of the S&P 500, which includes, again, the 500 of the largest US companies. So in this one, you basically get the diversification because it's going to be companies across multiple sectors. For example, you have Apple, Microsoft, Amazon, and Google. Since inception, since when the fund was created, it's actually had a return of 8.21% since it was created. In the past 10 years, it had almost 13% return on your investment. It's actually 12.94%. And in the past year, it's increased by 27.08%. And its expense ratio is actually just 0.04%, making it one of the cheapest ways to invest in the US stock market. So, for investors looking for a low cost and highly diversified option, this one is actually a pretty good contender. The second one I'm going to bring up is the Vanguard Value Index Fund. So, this one is an excellent choice for investors that want stability. This fund invests in large US companies that tend to grow at a slower pace. For example, young companies, or let's say technology companies, they're known for faster growth. But these are more larger established companies, and they're generally known for slower growth because they're more steady and more stable. It's less risky. For example, these companies include Johnson & Johnson, Berkshire Hathaway, and Procter & Gamble, and many others. But this fund specifically, since it was created, actually has had an average return of 7.68%. And in the past 10 years, it has a return of 10.46%. And in the past year, it's actually had a return of 23.57%. So this fund usually is a pretty appealing one to more conservative investors that are looking for steady growth with minimal risk. But the one downside is that this fund may actually underperform during bull market runs when high growth companies dominate the stock market. Number three that I want to share is actually an index fund that tracks the NASDAQ, such as the QQQ or the QQQM. And investing in a fund that follows the NASDAQ, like the QQQ or the QQQM, basically gives you exposure to the 100 largest non-financial companies listed on the NASDAQ. And this includes top technology firms such as Apple, Amazon, and Google, and many others. This fund is actually known for its strong long-term growth, driven by innovation in sectors like technology, healthcare, and consumer services. So basically, these funds provide diversification across high-performing industries and has usually outpaced broader indices such as the S&P 500, at least in the past decade. Because again, this fund focuses more on fast-growing innovative companies and is ideal for investors that are seeking capital appreciation and are willing to accept more volatility and risk for higher potential returns. So for some of the basic information, since this fund was created, the QQQ, that's the one I'm using as an example, has returned almost 10%, so that's 9.86% specifically. Since the last 10 years, it's returned 17.89%, and in the last year, it's had an average return of 27.02%. So those are three of the more popular index funds. If you do choose to invest in those, then my suggestion to you is to invest in it continuously, but plan to hold them for decades or for a very long time, because that's generally the way to go with index funds. But let's actually talk a bit more about why choose index funds in the first place. And really the best thing about index funds is really how simple and easy to use they are, because instead of needing to actively manage your own portfolio, which requires maybe a lot of specialized knowledge on stocks and their companies and specific companies. Normally you have whole teams kind of research and do this type of work. So as an individual, it's a lot harder for you to do that by yourself. But index funds, again, they're easy to understand and require very little effort to actually manage. And the kicker is that they've historically actually outperformed actively managed funds. And this is something I learned back in business school. This was one of my finance professors when he was telling us. Statistically, an actively managed fund or all actively managed funds as a whole, has generally underperformed against passively managed funds. Meaning when you actually hire those fancy Harvard MBAs to manage your funds in hopes of making you more money, on average, you would have actually had better returns if you just taken the person out of the equation and just followed one of those typical index funds such as the S&P 500 or the NASDAQ. So again, the average person usually just doesn't have the time or the knowledge or the resources to successfully manage a portfolio of individual stocks or engage in active trading strategies. But with index funds, it's basically you can set it and then fire and forget. knowing that you're going to benefit from the long-term growth of the stock market. As a bonus, know that you're likely going to outperform many or majority of actively traded funds. The other one additional thing is something I've previously mentioned, but index funds usually have significantly lower expense ratios than actively managed funds. And while in a percent form, it may not actually seem like that much depending on who you are. But again, actively managed funds usually have higher fees because they have to pay salaries of the fund managers or their analysts. Over time, these fees are actually going to start snowballing and they really add up. So, in contrast, index funds have very low expense ratios, meaning you end up paying a lot less to the fund managers and more of that money is yours to keep. So, that's really about all I have to say for this video. So, in summary, for most investors, index funds are actually a very straightforward and low cost and effective way to build wealth over the long term. So take a look at some of the index funds that I've mentioned, or take a look at some of the other ones on your own that you find from your own research, because there's actually a lot of them out there and different ones for different people. Whatever your investing strategy is, you can probably find an index fund that matches whatever you need. So that's whether you're a conservative investor looking for a stability, or maybe you're a younger investor willing to take on more risk for higher potential returns. These funds are basically going to give you a solid foundation for a lifelong investing strategy. And ultimately, the key to success is being consistent, allowing your investments to grow over time with minimal interference and costs. So that's really all I have for this video. Thanks again for watching. Please like and subscribe, and see you all in the next one.